Monetary policy, instruments and system. Friends, let me start this lecture with a quote from Henry Ford. I quote, "It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning." This is how the importance of monetary policy in the economy is depicted. The success of economic stability depends on how the government manages its credit supply in the economy. The functioning of money market, capital market and financial sector depends on the approach of government towards money supply and credit creation. The principal organ of every government is to regulate, control and monitor money supply, credit creation as well as the process of capital formation and capital mobilization with the help of central bank of that country. The central bank therefore can be rightly called as the regulator, monitor, promoter and architect of the monetary system. In India, it is the Reserve Bank of India that works as the principal regulator of money market. Since 1930s, the role of central bank in economic management has changed significantly. It is now recognized as a basic banking regulator and custodian of the economy. Central bank adopts different policies for different situations and to overcome various economic crises. Central bank works as a friend, philosopher and guide of the government to overcome the challenges of cyclical fluctuations in the economy and the issues affecting the success of certain economic policies. The prudent economic management, stabilizing the credit supply, efficient monetary management as well as consistency and policy measures are the four pillars of sound economic management. Central bank effectively performs these functions by applying various systems, policies and mechanisms. Monetary policy is one of the pioneer and the principal instrument in the hands of the central bank. As a regulator of the economy, monetary policy becomes a very essential instrument of economic intervention in the hands of the central bank for proper economic management of the country. How the monetary policies are changed and redesigned considering the requirements of the economy is a very important issue that we need to study. The term monetary policy often is defined as the macroeconomic policy laid down by the central bank. It involves management of money supply and interest rates, and it also considers the demand side of economic policy used by the government of a particular country to achieve certain well defined macroeconomic objectives. These objectives can be related with inflation, consumption, growth as well as liquidity in the given economic situation. Monetary policy is thus a very important instrument of economic management. In this lecture, we are going to study various instruments of monetary policy and its implications on the success of economic management. What are the instruments or techniques of monetary policy? The instruments of monetary policy are the tools which are used by the monetary authority in order to attain some predetermined socio-economic objectives. These instruments can be classified into two simple categories: the quantitative instruments or the general tools, the qualitative instruments or the selective tools. Let us now try to understand these tools at length. The quantitative instruments, also known as the general tools of monetary policy, are related to the quantity or volume of money in the economy. They are developed and designed to regulate and control the total volume of bank credit in the given economy. These tools are indirect in nature and are employed for influencing the quantity of credit in a given economy. The general tools of monetary policy and credit control are explained here. Bank rate policy. The bank rate policy is a very important technique used in the monetary policy for influencing the volume or the quantity of credit in a given economy. The bank rate refers to the rate at which the central bank rediscounts the bills of commercial banks or provides advance to commercial banks against approved securities. Any change in the bank rate inevitably brings out a resultant change in the interest rates of the commercial banks. An increase in the bank rate reduces the volume of commercial banks' borrowings from the Reserve Bank of India or the central bank. It also restricts the banks from further credit expansion as it becomes more costly affair. On the other hand, in case there is a decrease in the bank rate, borrowings for commercial banks will be easy and cheaper. This will boost the process of credit creation. Any change in the bank rate is normally associated with the resulting changes in the lending rates of interest. However, the efficiency of the bank rate as a tool of monetary policy depends on various factors such as the existing banking network, interest elasticity of investment demand, size and strength of money market, and international flow of funds in a particular economy. Open market operations. The open market operation refers to the purchase and sale of short term and long term securities by the Reserve Bank of India or the central bank in the open market. Open market operations are used for a variety of reasons, such as to eliminate the situation of shortage of money in the money market, to influence the term and structure of interest rates, to stabilize the market for government securities. This is very effective and popular technique of the monetary policy. It is important to understand the working of open market operations as an important technique of monetary policy. If the commercial banks and the private individuals buy the securities offered by the central bank or RBI in the open market, money gets transferred from commercial banks to the Reserve Bank of India or the central bank. This reduces the purchasing power in the hands of public and contracts the existing supply of money. In this way, through open market transaction, the central bank controls the money supply in the economy. During the inflationary phase, the central bank sells securities in order to reduce the purchasing power. During the recessionary phase, the Reserve Bank or the central bank buys the securities and increase the supply and availability of money in the economy through the banking system. Thus, under open market operation, there is a continuous buying and selling of securities taking place, leading to changes in the availability of credit in the economy. There are certain factors that limit the effectiveness of open market operations like underdeveloped security market, excess reserves with commercial banks, indebtedness of commercial banks and many other such factors. Variations in the reserves ratios. According to the central bank or Reserve Bank norms, the commercial banks have to keep a certain proportion of their total deposits in the form of cash reserves for the purpose of maintaining liquidity and controlling credit in the economy. These reserve ratios are of two types, such as cash reserves ratio or CRR and statutory liquidity ratio or SLR. The CRR refers to some percentage of commercial banks' net demand and time liabilities which commercial banks have to maintain with the central bank. The statutory liquidity ratio refers to some percentage of reserves to be maintained in the form of gold and foreign securities. However, during the recession, it lowers the percentage of reserve ratios, making more cash reserves available for credit expansion. Qualitative instruments or selective tools. The qualitative instruments of monetary policy are also known as the selective tools of monetary policy. These tools are not used to control and regulate the general money supply. They are used to extend and regulate credit of certain select sectors of the economy. These instruments are used for discriminating between different uses of credit. This method of monetary control can have influence over the lender as well as the borrower of the credit. Let us try to understand the selective tools of monetary policy at length. Fixing margin requirements. The margin refers to the proportion of the loan amount which is not financed by the bank. In other words, margin is that part of loan which a borrower has to raise in order to get finance for a particular purpose of taking a loan. A change in the margin brings about a change in the size of loan amount. This method is used to encourage credit supply for the needy sector like agriculture by decreasing the margin. Likewise, an increase in the margin discourages credit supply for other non-necessary sectors, for example, margin for acquiring car loans. In case of India, Reserve Bank of India has the authority to change the margin for different sectors. For this, it prioritizes the credit needs of different sectors and decides the margins accordingly. As such, this method can be employed for meeting the credit requirements of priority sectors like agricultural industry. Consumer credit regulation. Consumer credit regulation method of selective credit control helps to regulate consumer credit supply. Under this method, the down payment and the installment amount and the loan duration are the dominant factors. For hire purchase and installment sale of consumer goods, these margin limits are fixed in advance. This can help in checking the credit use and inflation in a given country. Publicity. This technique of selective credit control involves the central bank making public statements regarding what is good and what is bad in the system through various reports published from time to time. This published information helps the commercial banks to extend credit supply in the right direction towards the desired sectors. These publications are made freely available in the form of weekly and monthly bulletins and can be used for attaining goals of monetary policy. Credit rationing. Under this method of selective tool of monetary policy, the central bank fixes credit amount to be granted to the commercial banks. Credit is rationed by limiting the amount available for each commercial bank. This method controls even bill rediscounting facility. For certain purposes, the upper limit of credit can be fixed and banks are directed not to exceed credit beyond such limits. Moral suasion. This method refers to the pressure exerted by the central bank or the RBI on the banking system without strict enforcement of any regulation. Under this method, the commercial banks are informed about the expectations of RBI through a particular monetary policy. The central banks can issue directives, guidelines and suggestions for commercial banks regarding reducing credit supply for speculative purposes. It helps in restraining credit during inflationary periods. Control through directives. Under this technique of selective credit control, the central bank issues frequent directives to commercial banks in order to guide the commercial banks in framing their particular lending policy. Through issue of such directives, the central bank can influence credit structures, supply of credit to certain limit for a specific purpose. The Reserve Bank of India may issue directives to commercial banks for not lending loans to speculative sectors such as securities beyond a certain limit, especially when the economy is going through an inflationary phase. Direct action. If certain commercial banks are not adhering to the RBI directives, RBI can impose an action against those banks. Some of the direct actions imposed by RBI are enumerated here. 1. RBI may refuse to rediscount the bills and securities of certain commercial banks. RBI may refuse credit supply to those banks whose borrowings are in excess of their capital. RBI can penalize a bank by changing certain rates of interest. RBI can also put a ban on a particular bank if it does not follow its directives and works against the objectives of the monetary policy. The success of the selective tools of monetary supply is often influenced by certain factors. These factors are availability of alternative sources of credit in the economy, nature of functioning of non-banking financial institutions, profit motive of commercial banks, but a right mix of the general and selective tools of monetary policy can certainly help to attain the objectives of monetary policy and give the desired results. Transmission mechanism of monetary policy. The monetary transmission mechanism refers to the mechanism by which the changes in the supply of money produce the effect which, by interacting with the economy's real sector, create changes in the income and in the general price level. This is a process that takes place with the help of two primary mechanisms. These mechanisms are portfolio or relative price mechanism, and the second is wealth mechanism. Portfolio mechanism. According to this approach, monetary policy operates directly on the total spectrum of spending rather than simply through investment spending, as often emphasized by the neo-Keynesian approach. A change in the money supply will initially affect the interest rates associated with these assets as individual wealth holders readjust their asset portfolios. As a result of this operation, wealth holders exchange government securities for central bank notes, increasing the quantity of cash balances in their individual portfolios. This in turn creates a temporary imbalance of excess cash into their portfolio. As the wealth holders try to adjust their portfolios by purchasing interest bearing non-cash financial assets, the prices of these assets are driven up, reducing the market rate of interest in the process. The increase in the prices of financial assets thus encourage the issue of new financial assets. The money received from the sale of these assets is then used to finance the purchase of the real investments. This causes the income to expand via the investment multiplier. Wealth mechanism. The wealth mechanism is the basis on the manner in which changes in the quantity of money affects the non-human net wealth. It also considers the manner in which this, as a result, influences the aggregate demand. Monetary policy in developing economy. The purpose of every economic policy is to increase the pace of development. The universally accepted goal of the economic policy is to maintain the pace of development of economy. This can be achieved by adopting a sustainable development policy. Whether an economy is in the phase of development or it is a developed economy, the focus is always on the pace and direction of growth. A government has to adopt a policy that offers stability to the growth process. Monetary policy is thus an instrument that offers a sound and definite direction to the growth process. The principal requirements of growth driven economy are maintenance of domestic price stability, fixed realistic foreign exchange rate. In developing countries, the most disastrous effects are produced by rising prices and frequently fluctuating foreign exchange rates. It often retards the rate of growth as the process of capital accumulation is discouraged due to low rate of domestic savings. In certain cases, the inflow of foreign capital is also reduced. The scarce economic resources cannot be properly allocated, which in turn creates suppressed inflation. For most of the developing countries, the key economic features affecting the growth process are suppressed inflationary trend, scarcity of basic economic resources, unrealistic foreign exchange rates, low rate of domestic savings, transfer of funds and capital from more essential sector to less essential sector, growing imbalance in demand and supply. Considering these bottlenecks in the growth process, the monetary policy in developing countries should emphasize on certain key areas. This shall help to achieve high economic growth and face the critical problem of various economic obstacles. The aims of monetary policy in developing economies can be enlisted like this: A. To facilitate the flow of adequate volume of bank credit to industry, agriculture and trade to finance their genuine needs. B. To provide selective encouragement to essential sectors needing special assistance. C. Often the monetary policy is directed to help the weaker sections of the community and the priority sectors of the economy. D. The sole intention of effective monetary policy in developing economy is to curb inflationary pressures. E. It also aims at controlling the undue expansion of credit. F. It attempts to prevent undesirable and unproductive use of credit. G. It promotes employment generation through productive deployment of resources. Let us now understand the merits and limitations of the monetary policy. The central bank of every economy adopts a two-way controlled expansion of credit. On one hand, it has the responsibility to ensure the economic growth of the nation, whereas on the other, it has also to check on economic evils like inflation and recession. As such, it takes steps to expand bank credit continuously and cautiously by using certain quantitative and qualitative methods of credit control. In other words, the central bank aims to maintain a balance between two crucial economic activities, economic growth and economic stability. Let us understand the merits and limitations of monetary policy adopted by the central bank for efficient economic management of the country. Merits of monetary policy. The first, stability of exchange rates and interest rates. The central bank develops various methods to maintain stability in interest rates and exchange rate. These methods include liquidity adjustment fund, open market operation, market stabilization schemes and alike. Financial and macroeconomic stability. The central bank maintains financial stability with the help of various monetary policy instruments, appropriate regulative and supervision and control mechanism. This control mechanism of the central bank also helps to face the situation of global crises and maintain macroeconomic stability. Financial inclusion. The central bank creates a great impact on the economy and society through its financial inclusion initiatives. The monetary policy of the central bank is designed with a view to support the institutions and bodies that help in growth of microfinance, such as the Reserve Bank of India has extended support to various self-help groups. Adaptability. The central bank usually adopts a flexible monetary policy which is designed to incorporate changes that occur in the dynamic economic environment. Owing to this attribute of a flexible monetary policy, the central bank can develop new methods of credit control and credit creation. Increase in the pace of economic growth. The monetary policy of the central bank plays a very important role in giving a boost to the pace of economic growth. Through the various monetary policy measures adopted for credit creation, the central bank helps to contribute towards GDP of the economy. Increase in people's confidence in the banking sector. A sound monetary policy helps to develop trust and confidence in the minds of the general public toward the financial and the banking system. This increases the bank deposits and investments in securities which help in capital accumulation and mobilization. It also helps in enhancement of credit creation objective of the central bank for a particular economy. Healthy competitive spirit between banks. A sound and flexible monetary policy of the central bank helps in development of healthy competition among banks in the country owing to certain positive measures such as deregulation of interest rates and decrease in the reserve ratios. There are a few limitations of the monetary policy as well. Let us understand these limitations. Huge budget deficits. The central bank through its various monetary policy measures tries to control inflation and balance the money supply in the economy. However, the monetary policy measures become more or less ineffective if the economy faces the problem of budget deficit. If an economy has faced the budget deficits perpetually, it becomes a chronic economic problem. To curb this problem, the central bank may resort to deficit financing solutions such as printing of notes which artificially increases the money supply. This in long run has a disastrous effect on the economy. Covers only the commercial banks of the economy. Instruments of monetary policy of the central bank cover only the activities of the commercial banks. Thus, the inflationary pressures caused by banking industry can be controlled by the central bank of the economy through its monetary policy. However, there are many other economic factors that cause inflation such as artificial decrease in the supply of goods, hoarding and many such things which are not within the scope of the monetary policy, which is also a major limitation of the monetary policy. Corruption and mismanagement in the banking and financial sector. The monetary policy measures of the central bank can prove effective only when there is an efficient management of banks and the financial institutions. But if the officials of these institutions are corrupt and inefficient, it leads to financial scams which ultimately adversely implicate the entire economy. Thus, corruption and inefficiency are the factors that limit effectiveness of the central bank. Unorganized money market. The central bank of the country does not have any control unorganized sector of the money market. As such, the presence of unorganized money market sector in the economy is one of the main obstacle in effective functioning of the monetary policy of the central bank. Lack of accountability. If the goals of the monetary policy are not set in specific terms and if there is no clarity in monetary policy objectives, the implementation of monetary policy instruments will not be effective. This is because the accountability tends to be weak in such a setting. Thus, the government and the regulatory bodies like the central bank will not be able to carry on with their responsibilities. Black money. Every economy nowadays is facing a very critical situation of black money. The growing presence of black money in the economy is like a chronic disease which weakens the economy from within. Black money falls beyond the purview of control of central bank. As such, a large portion of the total money supply in the country remains outside the purview of central bank's monetary management. This also is a major factor that limits effectivity of the monetary policy. Lack of transparency. Lack of transparency in the system is also one of the very important drawback that limits the effective implementation of monetary policy instruments. For a more effective monetary policy, it would be necessary to have greater transparency in the policy formulation and transmission process. Thus, economic stability and economic growth are two major objectives that the central bank tries to achieve through designing and implementation of monetary policy. The functioning of money market, capital market and financial sector depends on how effective the central bank's monetary policy is. There should be right balance between the two important functions of the central bank, that is credit creation and credit control simultaneously. The central bank can strike this balance through its various monetary policy instruments. All these instruments are equally important. However, all the instruments cannot be implemented simultaneously because the monetary policy instruments are selected according to the needs of the particular economy. Thus, monetary policy is a very important tool of economic management in the hands of the central bank and the government as well. Let us hope that these pioneer institutions will manage our funds and money effectively in the interest of the public and the society at large. Thank you very much.